In this video, you'll be learning about this topic.
All right, so Robert, the thing that I want to just get into here at the start is really the essence of what we're talking about. And when we talk about the essence, we've got to cover the topic of what is money, because I don't think we can talk about any of this other stuff unless we first address that and come to kind of a common terminology, maybe a common understanding, maybe even let's challenge our given assumptions. So I'm kind of curious your thoughts on that.
That's a great place to start, actually. It's commonly believed today that money is a government creation. Money, actually, it's an emergent phenomenon in any trading society or any marketplace. And you can think about it quite simply as just the most tradable thing. It's literally the most liquid asset in an economy is by definition money, right? And so the simple example here would be like even cigarettes in prisons, right? These little micro economies, that becomes the most tradable thing, that becomes money. So what we can say about money historically, and by the way, this question, I love that you asked this question first, because I think this is where people hit a stumbling block, because they think money is issued by the government. Things like Bitcoin are not issued by the government. So clearly the government's never going to allow it. It's never going to work. So I think this question, actually, by asking it to yourself repeatedly and consistently, you go down the rabbit hole, right? What people describe as the Bitcoin rabbit hole. And you start to question the fundamental nature of a lot of the socioeconomic structures that hold us together. So I think it's a very important question for people to ask themselves. And from a first principle standpoint, what we know about money is that it's selected in the marketplace based on 5 critical properties. And a lot of people argue about these properties, say there's anywhere from 5 to 15. I've narrowed it down to 5. I think each of these have relevant subsets. So the first, money has to be divisible, durable, recognizable, portable, and scarce. These are the properties that people, market participants, naturally select for in money. So divisibility simply means that a money can transact at varying scales, meaning that you can subdivide and recombine the monetary medium at various scales, right? This is why we have coinage and things like bills that we've used historically. Durability means that the money will persist over time. So you know that it won't rot. So for instance, fruit would be a pretty terrible form of money, right? It's not durable over time, whereas something like a monetary metal like gold is. It's highly durable over time. It's non-corrosive. You know you can park a value in it and expect it to remain physically constant over time. Portability means you can move the money easily across space. And also a subset of this is actually securability. To be able to move a money across space, you actually need to be able to secure it easily as well. And then recognizability is the next property. Recognizability means you can verify the authenticity of a money or verify its veracity. You can tell that it's not being counterfeit. You can quickly assay its value, making sure that it is what the trading partner represents it to be. And finally, there's scarcity. And scarcity is a key property of money which essentially means its resistance to counterfeiting or supply inflation. Because with money, everyone that interacts with it has a direct financial incentive to increase its supply, right? If I can just print money, or if I can just discover a new gold mine, I have a huge incentive to pull it out of the ground or print the money and sell it into the marketplace. And what that effectively does is allows the person that can create the new supply, gives them a mechanism to confiscate value from all of those who use the monetary medium as a store of value or a medium of exchange. So historically, the free market zeroed in on the best tool or technology that best satisfied these 5 properties of money. And many things have been tried, right? We've used seashells, we've used salt, we've used cattle. Many monetary technologies have manifested in different markets throughout history. But the world zeroed in on monetary metals as money because they best satisfied those first 4 properties, right? Metals are more divisible, more durable, more recognizable, and more portable than other technologies. And of the metals, gold was the most scarce. Now we can quantify scarcity too. Another way to think about it is resistance to supply inflation, right? And there's a very popular metric in Bitcoin circles, also in precious metals circles, called the stock to flow ratio. We can think about this as the inverse of the inflation rate. So you're just taking 1 divided by the annual supply inflation. So for gold, for the past 50 years, its annual supply inflation has been just sub 2%. So if we say 1 divided by 2%, it's actually like 1.8%. So its stock to flow ratio comes in around 55 or 60. So of the monetary metals, gold exhibited the lowest and most reliable supply inflation rate, or said differently, the highest stock to flow ratio. And that's why markets coalesced around it as money, right? The free market naturally selected gold as money. Gold historically has been the truth of money, right? That's what market participants voluntarily adopted. Through entrepreneurial experimentation, countless trial and error, they determined that the best medium to store value in was gold.
Yeah, and it's not like diamonds. Like now you can go out and you can lab create a diamond. This is an element that's literally on the periodic table with respect to gold. And you can kind of see how that just naturally occurred over time.
Yeah, that's right. Like everyone knows today, it's almost ingrained in our knowledge that even in the way we talk about things, like that restaurant's a gold mine. I don't know if you've ever heard that. We know gold is valuable, right? It's so deeply ingrained in our understanding of economics. I like to say it's a tool that's so old, we forgot why it was useful, right? Not many people, anyone can tell you gold is valuable. Very few people can name you the properties of money and tell you why it was selected on the market.
Yeah.
But I think comprehension of these properties of money, which are the first principles of why a market selects money, are quintessential to understanding fiat currency and Bitcoin. And when we fast forward a little bit, so gold's been used for 5,000 years as money. However, it did lack in 3 properties that are very important, which necessitated the introduction of gold-backed currencies in paper form. So firstly, gold has a very high value to weight, right? Because it was favored on the marketplace. It's very heavy, very hefty. So for those reasons, gold actually lacks in the divisibility property of money. Like to be able to execute day-to-day transactions, right? Say buy coffee in gold, you would need gold dust almost, right? Like you need very small, highly fractionated units of gold. So by taking gold and abstracting it into a paper currency or even into coins, we were able to more deeply subdivide gold and use it for day-to-day transactions. And by the way, historically, this is too why silver had some marginal utility across history, because people tended to use silver as a day-to-day physical monetary medium, and gold would be reserved for larger wealth storage and settling of larger transactions. Secondly, gold suffered in the recognizability department, which meant that every time someone executed a trade, they would need to assay the value. They'd actually have to test the value and authenticity of the gold at each trade, right? So this clearly was uneconomic. It took a lot of time. It took certain techniques. It just increased the transaction costs associated with gold. So pretty quickly, and these emerged first as private businesses, people figured out that you could centralize the custody of gold into a warehouse. You could have this warehouse basically provide a stamp, right, on this warehouse certificate that's redeemable for gold. And then it represented that this one certificate is redeemable for 1 ounce of gold. So now instead of needing to assay the value of gold at each transaction, you could just trust the reputation and certification function of that business instead of needing to verify at each transaction. And then finally, gold lacked portability. Metals lack portability. Metals clearly are very heavy. They can be transported across space. However, there's a large cost associated with that, right? Both in terms of the actual logistics, transporting the gold, say putting the gold on a tanker and freighting it across the Atlantic Ocean, if you're a country in Europe trying to settle with the United States, for instance. but also it required a high degree of security, right? Gold was advantageous in that it had a lot of value density, so you only needed to secure a relatively small area to protect your wealth, but you had to guard it really, really well, right? It needs to be Fort Knox-like, if you will. It's essentially that gold is the best form of money we ever had, but it still had technological failings in these three properties of money. And that's why we introduced gold-backed currencies. That's how we got into gold-backed currencies. And those certification function businesses, over time, the economies of scale associated with that led to the centralization of gold custody into fewer and fewer hands, which became banks, which ultimately became the central bank. And that is the business, essentially, that the governments have monopolized and controlled throughout history.
So I want to ask you, even going into the essence of this a little bit more, when you talk about the last point of the five, which is the scarcity point, which is the point that I think anybody who doesn't even understand what's happening in the economy right now knows that there's some serious debasement happening and that there's a lot of printing taking place. Why is sound money important from that particular point of view of this debasement happening in the currency and the paper currency? Because we're not even on a gold currency, paper currency anymore. We're just on a paper currency. So right. As they're inflating that, what does that mean? Like, what's the spillover effect to businesses, valuations, all that kind of stuff?
So we get to these paper-backed currencies, right? Which are initially introduced as a matter of convenience, frankly, for transacting in gold, which again was the free market selected money. And what happened over time, especially with the implementation of central banking, is that those entrusted with safeguarding the custody of that gold and issuing certificates for its redemption one-to-one, right, which we now call banknotes, they over time gave in to the temptation to violate the trust placed in them, right? So initially it became more fractional reserve, where they may be issuing 3 notes for every 1 ounce of gold they have on deposit. Maybe it got to 10 eventually. And glossing over a lot of history, this gets us to the 1971 Nixon shock, essentially. In 1944, we'd established the Bretton Woods system, where the US dollar would be pegged to gold. Every other currency in the world would be pegged to the dollar. So we're effectively still on a gold standard. So what this did effectively was make the Fed the central bank of the world, right? And they inevitably printed more currency than their gold reserves could justify, which culminated in the 1971 Nixon shock of him eliminating the redeemability of gold for dollars. I actually think this came right in the wake of Germany trying to repatriate their gold after a few other countries had already done the same. And, Nixon basically said that's enough. And when that happened, this was an implicit default, right? They did not have the gold reserves to justify the currency in circulation, so they had to break the peg. And this took us away from a free market, right? We had gold, which was a free market selected money, into a monopoly, right? An unfree market with basically unfettered ability to further compromise the scarcity of money to benefit the politically favored few, whoever it is they select, whoever banks choose to give this money out to, at the expense of everyone else. So it's externalizing the cost of inflation onto the broader society and siphoning its gains towards those that the central bank selects, essentially. So we've moved away from this democratic free market selection process to a more tyrannical selection process through the central bank. And this, here we stand today in 2020, we're at the peak of this experiment, right? Since then, money supplies have soared, global debt to GDP has soared. There's been a number of socioeconomic consequences on fiat currency. On this topic, I would encourage listeners to go check out the website, WTFhappened1971.com. There's a number of charts and data, like divorce rates have skyrocketed, addictions, suicide, there's just a whole host of things you wouldn't expect to be connected to the money that have just coincidentally surged to the negative side since 1971, which I think is super interesting. But to your point about what happens in the valuation sphere when we break this anchor to economic reality that gold gave us, right? another way to think about this is the economy itself, the entire purpose, even the word economy, right? It means to accomplish greater results with less efforts, which is another way of saying doing things in less time, right? So we are trading with one another so we can each specialize in our own craft. And we know that we can go out into the market and redeem anything else that we need, right? Like you can be really good at running the show. You don't need to figure out how to sew your shirts and make your hats, right? There's people out there in the market that can do that better. And so we're optimizing our own productivity through trade, right? We're exploiting the comparative advantage. And in that system, all ratios of things trading to one another are expressed in prices, right? So instead of saying this microphone costs 3 hats, we say this microphone costs $20, this hat costs, $6 or $7. So money is just the medium through which we're expressing these exchange ratios. But what happens when a central bank compromises the scarcity of money is they're basically corrupting the denominator of prices. So they're corrupting the very system through which we communicate, which are prices, right? That is the incentive schema that guides human action in the marketplace, right? I don't need to know the reason the price of bananas went up, right? I just need to know that the price of bananas went up. I'm going to eat less or I'm going to eat some other fruit. But there might be, maybe there's a wildfire behind that, a tsunami, like who knows? So the price system itself is what I like to call this economic telecommunication network. And when you corrupt the medium, right, when central banks start selectively doling out currency and picking winners and losers, they're interrupting the Darwinian forces that are in the marketplace.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.